Welcome to Dealer Driven, where the rubber meets the road to success. This episode sponsored by Podium, the #1 converting AI employee for dealerships.
Most dealership software was built for yesterday's workflows. Podium is built for what's next. An all-in-one system with the #1 converting AI trusted by over 6,000 dealerships. Discover more at automotive.podium.com.
Welcome to Dealer Driven. I'm Michael Hayes.
And I'm Cameron Wilson. Today we're diving into NADA's quarterly economic report for the second quarter of 2026.
We'll be reviewing how the U.S. light vehicle market performed in Q2 and looking ahead at what could be in store for Q3.
As always, we're joined by Patrick Manzi, Chief Economist at the National Automobile Dealers Association.
Let's get started.
Patrick, welcome to the show. We're so happy to have you.
Thank you so much for having me back, Cameron and Michael.
So, Patrick, before we dive into the numbers, can you give all of us listeners here of this wonderful podcast that we are so lucky to be a part of a quick reminder of the key economic forces that were at play going into Q2? Not like there was that much going on, of course. And thinking about now that we've closed out, what do you think mattered most, and which things might be misleading us right now?
Sure, yeah. So it appears we are in the wind down phase of the Iran war. The Strait of Hormuz traffic has started to pick back up again. Oil prices have come down. My indicator is my local station, and it was as high as 450, and it's now I think 355 this morning. So prices have come down a lot, and so that's a really big thing, and we can start to see commodities flowing again more regularly, and hopefully that can get ahead of or help with some of that inflationary pressure that was coming from all of these higher energy prices in the economy. We actually saw the CPI rise to over 4%. I think it was 4.2% during the last quarter. And almost all of that was higher energy prices. And so this is on the backs of, consumers really getting squeezed over the past few years with rising prices for almost everything in the economy. So we want to move past this. Other surprises, we had a really strong labor market last quarter. We've averaged 92,000 or so jobs per month this year, but most of that jobs gain came within the last quarter. Unfortunately, it's not broad-based. It still continues to be mainly healthcare jobs being added, and that's because it's seeing the baby boomer generation, really transition into retirement, and there is a lot more care needed for that generation going forward. So that has really been the strongest hiring. So when you look at the headline numbers in the jobs report, you see we're adding over 100,000 jobs, whatever that may be. Underneath it, the gains are very targeted, and it's still tough for people out there trying to find work. If I think the share of people who have been unemployed for longer than 27 weeks is now at like 27%. So you may find people who are really takes a long time to find a job if you're outside of healthcare, outside of certain in-demand positions. So there is this the headline stats are saying things are really humming, but underneath it is a little more nuanced. Also, you would see something like that when you see, some of our consumer spending statistics or GDP growth statistics. GDP growth looks pretty solid, but underneath that, what you see is most of the growth in GDP is coming from these big investments in AI and the data center world to help build us out for this next transition. But consumer spending is up, but a lot of it is consumers kind of maybe shifting away from, what's the word I'm looking for? Discretionary purchases and having to pay more for some of those necessities. It's not everybody out there is out there spending on a lot of luxury goods. And we continue to see this, bifurcation trend almost it's growing, I would say, where wealthier households have a lot more disposable income, and they are the ones driving a lot of this spending power, where Middle income folks are just kind of stretching that dollar, and folks at the bottom end of the income distribution are really hurting. So I've kind of thrown a lot there. And what I want, really the main takeaway here is that the headline stats look really good, but it's important to consider the nuances beneath a lot of these things.
So along that line, if I may, I've been reading, and I think you kind of allude to it a little bit, but that the actual workforce participation rate dropped in the last quarter too, and it might have led to I know we talked about unemployment rate actually dropped a little. The jobs report was good, but not so good to create that. Other than retirement, are there any other things you mentioned retirement? Any other things that you think are leading to a little drop in actual workforce participation rate?
Yeah, you're right. No, that's a very good point. So basically we're seeing is labor demand is low, but labor supply is also low too. And one of the big things here, labor force participation among young mothers or women of that age has fallen a lot because we have seen these return to office mandates. And so, there are a lot of mothers forced to make that very tough decision. Do I, pay $2,500 a month for childcare? Or do I just decide to leave the labor force and stay home and take care of these kids? So that is one issue. And then we also are still sort of dealing with now, although this one is starting to change, but a lot of people who are immigrants to this country, kind of left the labor force given all of the immigration enforcement that we saw all over the past year. And at this point, we are starting to see some of those people come back just because you can't stay if you're of working age, you can't sit on the sidelines forever. And so some of those people, I believe, are coming back. So there are a few things happening there. And you're right. When labor force participation falls, you can actually see the unemployment rate fall, even though, not much is actually happening. It's really just, that decline in overall labor supply.
So, Patrick, let's get a little more automotive specific. And from your vantage point, what were some of the standout trends in the light vehicle market over this past quarter?
I mean, it to me, well, okay, let me start with this one, actually. I just saw this. Honda CRV outsold the Ford F-150 in June. Now, the whole F-Series lineup, when you put F-250, 350, 450, whatever, they still outsold. That was still the number one. But if you just look at the F-150, which has traditionally been the best-selling car in the country, that's a pretty big issue. Now, again, under the surface, you have the Novelis plant here in the U.S. that has had several shutdowns. That's the Ford's biggest supplier for aluminum, and so they haven't been able to build as many trucks as they would want. So you had this supply constraint that was limiting production. But still, I think that's a really big milestone, for Honda to achieve that, and it shows they've been allocating a lot of their production to that specific model. And also, this was sort of a perfect storm for them because RAV4 was undergoing a model changeover over the past 6 months or so. And so they didn't have nearly as many RAV4s to sell. So I suspect this will be a short-lived but still notable, market change. And I'm sure the dealers out there for Honda are feeling pretty good. That's a really big accomplishment to dethrone F-150. Let's start with that one. The other thing is, we with this fuel price spike, we have continued to see shift to hybrid, right? And hybrids are, I think, right around 15.5% of the market. Market shares growing 2 to 3 points. We see that year over year gain each month when compared to the previous year. And BEV sales are, off about 25% year over year. And I think they're only around 6% market share. So the trend continues to be very clear that this shift to hybrid is happening. And I think OEMs who do not have product need to hurry up and get some product out there because they're going to continue to lose share to brands that do.
So, as a follow up to that, and you kind of alluded to a couple of these things already, over this last quarter, dealers and consumers have been hearing about tariffs, the Middle East conflict, fuel price spikes, and affordability challenges, yet demand has remained relatively resilient. Do you think the industry is structurally stronger than it was in prior economic cycles, or are we simply delaying an eventual slowdown?
So I alluded earlier to sort of the K-shaped spending dynamics we're seeing across the economy. And, what the demographics of who buys new cars has shifted even since the start of the pandemic. So Cox has some really great data they put out pretty regularly that looks at new buyer income shares, and to see which groups are buying the most new cars. And this is just one notable stat. 50% of new car sales went to people with incomes under $100,000 in 2020. That's now fallen to 36% of buyers. And at the same token, the share over 200,000 has risen from 18% in 2020 to 30% today. So the industry is, focusing more on building products for those wealthier customers, and they are the ones responsible for a larger and larger share of these new vehicle sales. And they also happen to be the ones who have seen the highest wage growth, and are able to continue spending. So what I think is happening is just our industry is benefiting from this dynamic in the economy, in that wealthier folks continue to power most of that spending. They happen to be the one buying more new cars, and that has supported robust sales so far this year in the new vehicle market.
So how does that affect then inventory shifts? What kind of inventory shifts did we see through Q2, and what's the story behind those changes?
Inventory, I think, has been up the past 3 months. It's not like massive jumps each month. We're sitting around 2.6 million or so cars on the ground and in transit. So it hasn't really changed too much when you look at that overall perspective. And in fact, we're expecting inventory to be around that level, maybe a little less by the end of the year. So this is sort of our new steady state for inventory levels. And I do believe that OEMs right now are prioritizing. If you make hybrid, they're building every hybrid they can possibly build. And I think we're probably going to see, maybe in those really competitive segments, maybe targeted build outs of sort of that lower, not quite entry level trim, but that maybe one trim step up. I think there's going to be a lot of build combinations happening there, because again, this affordability issue, is one of those things that it's the story of the year. It's the story of the last couple of years, really, in the auto industry. And so they want to make sure that they're going to have those right products for the customer.
Most dealership software was built for yesterday's workflows. Podium is built for what's next. An all-in-one system with the #1 converting AI trusted by over 6,000 dealerships. Discover more at automotive.podium.com.
Patrick, you've already mentioned hybrids, but I'm wondering, did you notice any changes in consumer demand for EVs or traditional gas-powered vehicles? And maybe it's more focus on, I believe there's a flood of used EVs entering the market.
Right. Yeah. So on the new side, fewer choices. I really, most of what's being sold this quarter, I believe Tesla is now back around 50% of all those battery electric vehicle sales. They had a strong quarterly improvement in their sales. So on the new side, really, there's not much of a story to tell, other than the market is, market share is reflecting true demand now. There's not really incentives propping it up. But on the used market, this spike in fuel prices, and I think, you know, just the residual values that used EVs have experienced over the past few years have suddenly made them an attractive option, for that used vehicle customer. And, we've actually seen retention values pick up on some of those used EVs. And I think part of that has been the higher demand from the used vehicle customers. So actually, EVs in the used space are doing very well. Still, though, another side of this too is OEMs are working. So I think we've talked about in previous. Let me just take one step back. We've talked about in previous podcasts how there is expected to be this flood of EVs coming back over the next few years, simply because we leased a lot of them over the past few years because of the EV tax credit and because of uncertain residual values. So now, as they're starting to come back, I think a lot of these OEs are like, oh my gosh, we might take a big bath on some of these models coming back. And so they're doing what they can to keep some of these EVs out of the wholesale channel. One thing I read about yesterday was, customers coming back, you have your agreed upon residual, and the OEM offering a discount on that residual for the customer to take possession of that car and buy it and keep it out of the auction channel. So they want to support, they don't want to like dump all of these at once. They do want to have some support for their residual values of the vehicles that are hitting the auction. So they are trying some like new things to entice customers to maybe buy these cars off at the end of their lease. So that's just, one of the interesting things we're seeing out there, because I really do think we are going to start to see more strategies here from OEMs, maybe either residual buy downs or something of the like that will encourage consumers to keep these, because they really don't want them all to hit the auctions at once and tank residuals. So yes, there are some interesting things happening, but they're more on the used space than on the new side with EVs.
So when we're talking, we're talking about affordability, and let's keep going with that. You're talking about the average payments greater than $800 a month. I think I saw a thing, almost 20% of new car payments are over $1,000 a month now. And thinking that become longer term, you kind of highlighted it earlier, but let's talk a little longer. Are we more of an affordability constrained market right now? And if that's so, then what kind of metrics should dealers be watching closely about preparing for the fact that this is an affordability constrained market to a large degree?
Right. You're right on about that. So there's a lot going on when we talk about affordability. Number one, you have people who just generally, maybe you want a nicer trim of that car, so you want to pay for that. That pushes the price up a little bit. But the other side of it is, so you're having both consumers selecting a higher trim vehicle or a bigger car, whatever it is. That's one part of the question, one part of it. The other side of it is the consumer's getting squeezed on everything else. So car insurance is up, maintenance is up, housing, daycare. I could go on here, but so the purchasing power that a lot of these consumers have has been sort of eroded. And then when you take a look at these headline stats, $800 payments and stuff like that, I mean, I think like when you compare these vehicles from 10 years ago to today, you most cars, with the exception of a few outliers here, you get more performance, more fuel economy, more safety, more features. And when you adjust for inflation, the price really hasn't gone up too much. So there is a lot of self-selection from customers. You just have the higher prices just because we live in an inflationary world where prices are rising. And some of these numbers coming in are just a consequence of that, just the higher price. But in the reality, if you step back and take a look at this, you do get a lot more for this higher payment. And when you adjust it for inflation, a lot of those things they really haven't gone up that much. So, what should the dealer do when the customer says, "I just won't pay 800?" Because I'm one of those people. I'm like, I'm not paying over $500. It's not happening. I'm not going to do it. So to deal with that, I think it's just look to have a wide array of price points. And I know that's a lot easier than it sounds. And I know that, for a lot of people coming in, they're looking for that under $15,000 used car, something like that. And that also happens to be the most supply constrained on the used vehicle side. That's the lowest day supplies in that area. So to me, I would say, just try to have a broad array of products if you can. If you're lucky to work for a store that has a full line manufacturer, that's probably already going to be built in for you. But if you're not really a full line manufacturer, which several really have kind of transitioned away from that, then we've been saying on the past few things, stocking the right used cars is going to be totally key going forward, because they're I know I'm trying to like discount this affordability issue. It's weird, but I just think it's important we think about all of these things, right? Because it is a lot more than just the car is more expensive. It's kind of everything is more expensive, but you also get more. It's one of those sort of I'm blanking on the word here, but one of those issues that just has a lot of depth to it.
Absolutely. And used is where it's at anyway. So yes.
I'm more concerned about the issue of, in order to make that payment work, people are extending their loan terms, and that pushes out turn cycles. That increases the likelihood that you're going to get caught in that negative equity cycle. So it's less so like the payment and the price, but like don't get trapped in a high interest rate loan that you're rolling over repeatedly. That's more of an issue, I would say, than the sticker price.
Thank you. Well said. I totally agree with that. When you think about, for decades, we talked about GM, we've always considered them the dominant market volume leader in North America, at least. And Toyota has obviously momentum over the last few years has kind of taken that lead now, or will be taking it. Do you see this as a meaningful change in the competitive landscape? in North America?
Part of me wonders, is Toyota just happy being at number 2? Because I feel like they could probably stand up a couple plants and take number 1. I think they're just probably expanding a production or availability for a few of their key models, and they would really start to, I mean, they would become neck and neck. I think there's like a percentage point of market share between the two. So I want to say yes, because generally that's what economic theory would say is, yeah, I want to keep going after my competition. But I think there are some benefits here to maybe being a second mover. And Toyota's made some interesting choices, right? I remember, a lot of us in the industry remember that marketing tactic with the same reverse. One, you could build one BEV, 6 plug-in hybrids, or I forget, but it was like 60 or 70 conventional hybrids. It was a lot. The number was big. And so everybody's like, oh, yeah, Toyota's not going to do EVs. And Toyota was just waiting, right? Waiting. And all these players exited it. And now all of a sudden, here's Toyota with like 4 new EVs. So they were kind of a second mover here. They almost waited on their competition to, get hung up. And now they're here offering those products in segments that their competition has left. So it's a very interesting company right there. And I'm going to be paying a lot of attention to this, Michael, because I think they could take number 1, I think, with a few more changes, but I think they're happy where they are.
Mm-hmm. And the dealers are certainly happy with them. So, yes.
Yeah.
Yeah, they're very successful in second place.
You're right. Right.
So, Patrick, let's shift towards looking ahead to quarter 3. What are some of the major tailwinds and headwinds you're watching that could affect sales volume?
Right. So I think big tailwind, we talked about, the buyers of new cars are predominantly wealthy folks. Equities market valuations are still very high. And so I think that's going to be a really big tailwind for those people. That's one of the things that I'm kind of like, what could go wrong in this economy? Well, it's either the AI bubble pops, and that leads, and that could lead to a big equities market correction, and that makes people feel less wealthy. So that kind of bursts the bubble on, this higher income folks powering our particular market. But barring that, that is a big tailwind, is the ripping hot stock market for car sales in the third quarter. Headwinds, we kind of all those we were talking, I think, in the last report about tax return season being somewhat of a boost this year. I think a lot of that kind of got erased by higher energy costs from the Iran war, and anything that didn't, that's already been spent. I think that juice is out of the tank. So I would say, the big headwinds are just continued rising prices for everything and erosion of purchasing power. So that's going to be a big thing that's sort of omnipresent until inflation is back under control, running between 1% and 2%. And I do not claim to know when that's going to happen. I'm pretty sure it's not going to happen this year. Probably not going to happen, by the middle of next year. But we will see. We will see if this, if the end of the war is for real. It seems that way. So that's really just what I'm paying attention to. Any surprise energy shocks again, I think that's a pretty low probability thing for Q3.
So, as a follow-up to that, you already mentioned kind of that $15,000 price range for a used vehicle, kind of being the ideal price range that most people are looking for. But what's your outlook for the whole used vehicle pricing and availability in the months ahead?
Inventories have improved, but I think a lot of what is out there in the retail world was probably bought at a premium during that busy tax return season. So there is a chance that you could see some, maybe, on the margin, a little bit of downward price pressure here as we enter Q3. But I think it's just going to be a pretty solid, steady as she goes used market. And like I said, anything that the dealers could do to get some of that affordable inventory, whether it's your stock in Craigslist, Facebook Marketplace, the newspaper, to try and get some of those cars, whatever you could do to get that, I think will be effort well spent, because I think that's just really key. People are hungry for affordability, and if they're like me, they don't like $300 payment changes between cars. And so anything you can do to keep that down, I think will be a positive for your business going forward.
So looking at Q2, and you've given us a lot of great insights and thoughts, and other than the $800 payments, are there any other unexpected data points or trends that surprise you from Q2?
No, I think the last few years I'm coming to terms with, like, I will not bet against the American consumer, and we just continue to sell all these cars, and business has been pretty good despite a lot of big shocks to the economy. So I'm very optimistic. My forecast is still for 16 million units to be sold this year, which is a very robust year, I'd say, for the industry. Yeah, I'm very optimistic for the rest of the year.
Well, that's great. In addition to that, Patrick, what's one key takeaway or piece of advice that you'd offer to our listeners as they gear up for quarter three?
I don't want to veer into our legal and regulatory team's expertise, but talk with your counsel, visit the NADA website, and get your pricing in line. That's what I would say. Like, the FTC is out there. They're looking for your stuff. And with AI, they can detect any, funny business with pricing and advertising and stuff like that. So I would say, if you're not there yet, get that in top shape.
And that just helps the entire industry too. Absolutely.
You're right. It helps the whole industry. We're all going to be better off if we can just be more direct and transparent with the customer.
So, Patrick, thank you so very much for your insights today. As always, it's great having you on the show. Thank you very much.
Thank you all very much for having me, and I hope everybody has a great Q3.
That's all the time we have for this episode. A huge thank you again to our guest, Patrick Manzi, for joining us. If you're enjoying the show, leave us a rating or a review and tell a friend. Once again, I'm Michael Hayes.
And I'm Cameron Wilson. This has been Dealer Driven from NADA. Keep your dealership in drive, and we'll see you next time.